What's up, guys? So in this video, I'm just going to be going over what SMT is. There's a bunch of different names that you could call this: smart money tool, smart money technique. I wouldn't say that there's really a defined name for it. That's why I just call it SMT. What SMT is essentially a decorrelation in indexes or currency pairs. So it's essentially a divergence. So what I mean by that is one pair, for example, NQ, can be not taking out a short-term high, while ES, on the other hand, can be taking out a short-term high, the same short-term high that NQ formed at the same time. So one of them can take it out or sweep it, and the other one cannot sweep it. This is what's known as SMT. So the way that we could use this, for example, in this examples that I have right here, NQ did not sweep out. I'm going to actually get rid of these first. NQ did not sweep out this major high right here created. And let's say this high was created at 7 o'clock p.m., right? And then if we went onto the ES chart, let's hypothetically say that this high was also created at 7 o'clock. ES came up and took out this high, and we swept this liquidity. NQ, however, stayed underneath this high, the same high, and did not sweep it. This is bearish SMT right here. So we can expect if ES is taking out a high and NQ is staying lower, NQ is essentially dragging ES back to the downside. So ES is taking out the high and taking the orders up within above this area, because there will be orders sitting right above this area. So ES comes, fills those orders, and NQ, because it didn't take out the high, essentially is dragging ES back down. So this would be an example of bearish SMT. So right here, obviously, NQ doesn't take it out. ES, on the other hand, does take it out. So this would be a form of bearish SMT. Now that I've shown you these little line drawing examples, I can actually go onto the chart and show you a real example that actually is happening right now. So if we go onto both of these charts, on the left right here, I have NQ, and on the right, I have ES. So if I reset both of these, if I zoom in right now, NQ formed this short-term low and this short-term high on the hourly time frame, right? ES also did the same exact thing. We formed the short-term low and we formed the short-term high. But what happened here? ES is currently sweeping out this liquidity. We already took out this low on ES. The same low that was not taken out on the NASDAQ or on NQ. So this would be an example of bullish SMT right here. And it would be from this candle to this candle, because this is what did not sweep. And on ES, it would be from this candle, the bottom of this candle, to this candle, because this is the candle that is sweeping liquidity. So this would be a form of bullish SMT. So we can expect that this could possibly send price higher or send price to the upside. So SMT, it's very simple. It's just essentially when one pair or one index is taking out highs or lows and the other one isn't. Mind you, this low created on NQ, or these two candles right here, are the same two candles that are on ES with the timing. This candle was formed at 2 o'clock. This candle was formed at 3 o'clock. On NQ, this candle was formed at 2 o'clock. This candle was formed at 3 o'clock. So both of these candles, these are the same exact candles on NQ and ES. However, ES is sweeping one out and NQ is not. So once again, that's bullish SMT. We can expect this to possibly send price to the upside. And along with your other confluences that you use, fair value gaps, order blocks, all of those different things, you can use this SMT to kind of give you a directional bias. So let's say right here, we go on to a lower time frame. On the 15-minute, ES is obviously taking out these lows, and NQ is not taking out these lows. So we can expect NQ is essentially going to pull ES back to the upside, because ES took the orders that were underneath this low right here. Underneath this low, we came, grabbed those orders, And now we can expect NQ to drag ES back up. So this is essentially ES fell into this little hole right here, sweeping this liquidity, and NQ is going to be the driver to send price back up. And just like with every single other concept or confluence that you use in trading, they're not always going to hold. So this one right here, it could get invalidated and NQ could end up running down, coming down to these lows. Nothing is 100% in trading. But the way that you can use this to your advantage is you see these things happening. For example, you see this bullish SMT, and you could possibly frame a trade idea off of it. So if we went even lower on time frames, hypothetically, if I was like a breakout trader, I could say we have these highs right here. And since we have bullish SMT, I could say we could take a breakout to the upside past these highs because we have a bullish bias from these lows getting swept and NQ not sweeping out these lows. So that's just an example of how you can use it to your advantage and in the direction of your trade. Same way with ICT concepts. If you are seeing an SMT on one side of price, that can kind of give you a directional bias of where you think price will go, or where the nearest draw on liquidity will be, or where we are targeting next. So yes, that is SMT. It's very simple, and I hope that helped.